Welcome to GoldVisionLive. If you are new here, don't forget to subscribe. Today we are diving into the psychology of Forex trading because success isn't just about strategy, it's about mindset. Stay tuned to learn how emotions, patience, and discipline can shape your trading journey. Let's start.
When it comes to learning about trading, many aspiring traders focus purely on understanding fundamental analysis, technical analysis, and market sentiment. And while these are essential areas to master, there's one crucial element that's often overlooked: the psychology of trading. One of the biggest differences between successful traders and those who struggle isn't their strategy, it's their mindset. Let's be honest. We're all looking at the same charts, the same financial news, and often using the same indicators. So why do some traders consistently win while others lose? Because top traders understand themselves. They know how to keep emotions like fear, greed, and doubt out of their decision-making process. In this video, we'll explore the fundamentals of trading psychology, what it is, why it matters, and how you can start building the mental discipline that separates pros from beginners. By the end of this segment, you'll be better prepared to face the emotional challenges that every new trader encounters and start taking control of your actions. Life, like trading, is a roller coaster with its many ups and downs. When we are trading, we can go through a range of emotions, from excitement to fear, from fear to hope. Our emotions are controlled by the limbic system of our brain, which can explain why some new traders struggle to overcome one of the greatest battles of all time. And that is the battle between hope and fear. You are in the market, and you have a winning position. You get that happy feeling as you are in the green. But then suddenly, you start getting that sense of dread that at any moment the market will turn against you, and your position will start to lose. Fear dictates your actions, and you close the position very quickly, taking a small profit. Let's look at a different scenario. You are in the market and you have a losing position. Instead of closing it, you start to think, if I close the position now, the market will suddenly turn around, and I didn't need to take that loss. So what do? You hope that the market will turn, and you keep your position open until the loss gets bigger and bigger until you are forced to take a large loss, or you're stopped out. That is the battle of hope and fear. How do you overcome this massive hurdle? You need to turn those emotions around. When you are in the market with a winning trade, you need to hope that it will continue to rise and keep the position open with a set target in mind. And if you have a losing position, you need to be fearful that the loss is going to get bigger, and don't hold on to it. How do you conquer the battle of hope and fear? Firstly, it's being aware that it exists. As they say, as soon as you realize there is a problem, you are halfway to solving it. As well as that, you can start using a trader's diary, which can help you take emotions out of your decision-making. That we will discuss in another segment. Many traders get so transfixed with the potential big payout, they do not pay attention to the danger of loss. Now here it is. Every trader will have a losing trade. But the key is controlling that loss and making sure your account is protected. Traders who incorporate risk management into their trading strategy stand a much better chance of succeeding. But how do you develop a risk management structure? Stage 1. The general rule is only to use 1% of your account's equity in a single trade, and no more than 5% of your account's equity in the market at all times with all open positions. Example: your account balance is $10,000. You should only be putting $100 at risk in a single trade. Stage 2, always use a stop loss. Always make sure you're using a stop loss and trailing stops at all times. They can protect you. There are many ways to identify where to place your stop loss, using moving averages, trend lines, price action, to recognize potential support and resistance levels. Stage 3. Diversify your portfolio. Understanding correlations is key. The lower the correlation, the better the diversification. Example: Euro dollar and the British pound US dollar are generally highly correlated, which is good if the market is going your way, but not good if it's going against you. Stage 4. Manage your emotions. Now, trading is exciting. There's no way of getting away from that. If you're on a winning streak, it's easy to slip into increasing your trade sizes. But greed is not good. You need to maintain your composure and stick to your plan no matter what. Stage 5. Risk-reward ratio. Now this is crucial. If you're risking $100, your take profit should be at least $300. Using the 3-to-1 risk-reward ratio, you might end up having more losing trades, but your profitable trades will outweigh the losses, and your account will be in the green. By accepting risk management into your life as a trader, you will be in a far better position to achieve the success you truly deserve. Trading is a journey, and like all journeys, we can never be too sure of our final destination. However, for a trader to reach the destination we desire, which is to be a successful trader, we need to go through 5 stages, and these stages are unconscious incompetence, conscious incompetence, the awakening moment, conscious competence, and finally, unconscious competence. I know it sounds like a lot, but bear with me. Stage 1. Unconscious incompetence. This is where a beginner trader jumps into the market, not knowing anything. They deny the usefulness of skill and knowledge, and open trades without thinking. There are usually 2 outcomes. They crash and burn, or worse, they get lucky, and then they think trading is easy. Stage 2. Conscious incompetence. This is where a trader realizes they don't understand. They start to learn technical analysis, fundamental analysis, trading strategies, but they're still losing. Why? Because they have no plan. They're emotional in their decision-making. And at this stage, they blame the market, and even the broker, for their losses. This is the most difficult stage to get through. To find out if you're still in this stage, ask yourself, are you still emotional with your trading? If the answer is yes, you're still at this stage. Do you take accountability for your actions? If you say no, you're still at this stage. Is it the market or the broker's fault for your losses? If you say yes, you're still at this stage. Do you have a plan? If you say no, then you're still here. Hopefully, by realizing this, you'll reach the awakening moment. This is the moment where you see the light. You realize, despite all the knowledge you've gained, you still need a plan. You need to control your actions and take full accountability. If you can do this, it leads to stage 4, conscious competence. This is where a trader starts developing a trading plan. It might be broken down into simple steps, but they have to concentrate. They have to stick to the plan, or they'll slip back into incompetence. This takes time. It takes focus. But if you can stay in this stage, you'll move on to the final stage. Stage 5, unconscious competence. With so much focus and practice, the trader now doesn't even need to think about what they're doing. The plan is part of them. It has become second nature, a perfect working trading machine. By understanding these stages, this can help you reach the destination you truly deserve. Throughout this segment, I've said on many occasions, you need to have a trader's diary. Now, of course, I'm not talking about having Dear Diary to record how your day has been. I'm talking about developing a program which you will stick to with no hesitation to help you take out the emotions from your decision-making. This is how you develop a trader's diary. And this can simply be done on an Excel sheet. You build several columns, and these are as follows. Date. This records when you opened your trade. Asset. What asset you're trading. Euro dollar, British pound, US dollar, etc. Direction. Are you going long or short? Take profit. What is your target? Stop loss. What's the maximum amount you are willing to lose, according to your risk management plan? the reasons. Now this records the reasons behind your decision. This could be like, asset is approaching a key support level, or there is an MA crossover, or ECB press conference is approaching and rumors it will be dovish, etc. And finally, outcome, to record your results. Now here's the thing. You fill in all those columns apart from the outcome box. First, before you click trade. By doing this, you're not trading with emotions. Instead, you're going steady into the market with a plan and rational thought. As well as that, if you are disciplined and stick to this trader's diary, you will have a track record of results, which you can look back on and see what works for you and what does not. So what are we waiting for? Let's build our trader diary.